Okay, so good morning, everyone. Welcome to the macro snapshot for the end of the week. We are Friday, May the 23rd, 2025, recording this in the morning. Basically, we've had a fairly sort of quiet sort of overnight session. We have the Memorial Day weekend, long weekend holiday in the US coming up. Also in the UK, the markets are closed on Monday. So we can expect a bit of a low volatility. But just as you're expecting low volatility, Trump literally a couple of minutes ago just tweeted that he expects iPhones to be made in the US. Otherwise, they will be subject to a 25% tariff. So just interesting here looking at this chart, the reaction. This is a 3-minute chart. So this is obviously in extended trading hours. And you can see here that thanks to Trump's tweet, Apple's shares have dropped from $201 to about 195. So we can see here that Trump having a bit of fun. And on a more sort of serious note, that just means that there is still sort of stress about not only the sort of the budget and the reconciliation bill, but also the sort of the tariff situation here. So let's just quickly have a look and see what's going on, because it's a good moment just to pause here. So if we look at the ES futures here, we can see that first of all, is still in a bullish pattern. There's been a very strong V-shaped reversal, as you can see on the chart here. They're above the moving averages. The moving averages are sort of slowly sort of flat to pointing upwards, but they could definitely sort of go down because they are sort of in a sideways consolidation. Now, at this point, we've had some negative price action for the last 3 to 4 days, looking at the chart here. And I just wonder if this latest Trump missive, which we just got, as I said, a couple of minutes ago, could just be something in relatively low volumes today, low liquidity, just to push the equities down a little bit. And just to remind everyone that the tariff threat is still real, but also that it's a very unstable sort of situation here. So just from a technical perspective here, let me just, sorry, I've got a lot of stuff here on the screen, which you guys can't see. So it's a bit difficult to move things. Right, so okay, so let's just look at a few different levels here on the ES. As I say, this is where Trump announced his tariffs on April the 2nd here. So we're well above that. But that level there could be an interesting retest of support. So I'm saying something like about 56.90 or so. And if I look at it at the most recent up impulse, I'm just going to draw a fib extension here. And you can see here that where the fib zones lie, so that's the 50, or actually the 38, the 50, and the 61%. So that whole kind of sort of zone here, which you can see on the chart, basically also coincides with the tariff day announcement on April the 2nd, and also all of the moving averages. So just from a purely sort of technical point of view here, it would not be surprising if the equities come off a little bit more from, let's say, from about 5,900, where they are, down to 5,700. So it would not do any technical damage necessarily to the chart if the equities came down, let's say, 200 points. Having said that, the bulls at that point would have to step in, and I'm looking at a key level here. For me, seems to be about 57.25. That's a very key level. If we start to go below there, and again below those 50, 100, and 200-day moving averages, which also coincides with the 61.8% fib, that's when the technical damage is done to the chart. And you'd have to say then that the bears have regained control. And we could actually then see a bit of a nasty sell-off. But we're not there yet. As I say, it's Friday going into a long weekend. Let's just see how we trade around today. So apart from that, we also have the VIX going up just a little bit, still at levels. There's kind of 3 levels of VIX. We're not in the panic levels here, but we're not in the most placid levels, which we saw back in 2024. So we're not in the 14, 15, 16s. We're more trading a range between about 18 and 21. Just on this recent Trump tariff tweet, TTT, we have seen the VIX go up a little bit, but the curve is still in sort of a contango structure, which indicates that there's not enormous stress in the market at this point. In fact, it's relatively tranquil. So let's see how we go. Having said that, though, we are just now trading at the 200-day EMA, as you can see here on the chart for the VIX. So possibly that's a good support level, and the VIX doesn't want to go too much lower, especially going into a long weekend where we could have some headline risk. In terms of other stuff, just a bigger picture going on. the G7 meeting of finance ministers and central bankers has finished in Canada. Finally, with the communique, there was nothing sort of dramatic or no fireworks. They did actually reiterate that they would allow the markets to set FX exchange rates. So that was a sort of an interesting thing. I thought there was a low probability, but would have been a high impact that maybe they wanted to tweak the sort of the communique, but that didn't actually happen. The second thing which they said in the communique was that global trade imbalances needed to be sort of addressed. And I don't know whether that was a nod towards the situation in China, China's trade surplus. We shall see. So nothing really massive happening there, to sort of change the markets. So let's just look around and look and see what else happened overnight. Overnight, we did get some slightly higher than expected in inflation numbers, and we saw coming out of Japan. And we've seen the US dollar here, as you see on the chart, the dollar index pushing down. So at this point, just in terms of the technicals, at a pretty key level here, because we've broken below this shorter term fib retracement level at 61.8. All of the moving averages were broken below those. They're all trending down. So you've got to say that the trend in the dollar index, just from a technical perspective, still seems to be intact. And the highest probability thing at this point would be for the dollar index to test this recent low at 97.95. In theory, you could also argue that it might just sort of sideways consolidate, waiting for more information. What more information does it need? It needs more information on the US economy. It also needs more information about what's going to go on with the big beautiful act of going through the US Congress. So yesterday, just in terms of that sort of a taxation bill and the spending bill, yesterday that was approved by the lower house, so the House of Representatives. But the thing is now it has to go back to the Senate or up to the Senate for adjustments. And the idea here is that there are quite a few, I was reading this morning and overnight, quite a few fiscally conservative senators who basically are saying that they don't want to vote for any kind of deficit increase and they want changes. So the point is that the fiscal hawks, even amongst the Republicans, might be brave enough to stand up to the president and essentially say, no, we do not accept any more deficit spending. So if they do those amendments and send that back to the House for final sort of confirmation, that could have some interesting implications in terms of the Treasury market, which we'll get to in a moment. So just in terms of other stuff which we're looking at, yesterday we had the S&P Global PMIs. They were higher than expected. So that was a bit of positive sentiment, which is unusual because as we've seen recently, a lot of the sort of the surveys have been actually softer in sentiment than the hard data. So at this point, it looks as though the US economy is okay and robust, and there is going to be quite a lot of sort of spending from the government, or at least let me put it this way, that the deficits will not be cut in any dramatic fashion at this point. That could change, as I just said, if the Senate decides that they need some sort of serious sort of reappraisal of all of that. Okay, so just looking at the dollar index here on the chart, at this point, it does look as though the dollar is technically heading down towards to retest those lows, as you can see here on the chart at 97.88. But as I say, if the US hard data continues to remain robust, if, for example, there's less deficit spending, if Trump stops tweeting about the tariffs and the tariffs actually come down to, let's say, 7 or 8, 9, 10%, maybe, that would be enough just to halt the dollar. What did get the market's attention overnight in Japan? We can see that the Japanese yen here actually strengthening quite a lot against the US dollar. You can see here on the chart on the daily US dollar, you see again this big red candle here, which is going down to test quite possibly, again, a similar situation to the dollar index, to test these lows around about 140 or so on the USD JPY. Again, that's subject to what happens in the US and tariffs and also the spending and reconciliation bill. Now, the proximate cause for that was the fact that we had higher than expected inflation last night. Although just digging deeper into it, you actually have to understand that was the headline number, and the price of rice has risen quite dramatically over the last few months, and that's a big input into the inflation numbers there. So could this be sort of a temporary one-off thing, just the price of rice? The second thing to note in Japan is that actually that services inflation actually has moderated a little bit. So it's easy to jump to quick conclusions and say that the Bank of Japan will be forced or interested in hiking maybe at the June meeting, which would be supportive for the JPY, for the Japanese yen. But the Bank of Japan normally is quite sort of slow moving and conservative, and just on the back of the fact that a lot of this CPI increase was caused by a spike in rice prices, may just give them pause. We'll keep an eye on that. But just technically, what is interesting as well, just to note in Japan, it's not full sort of weakness USD JPY because again, just looking at this chart here, which I'm going to pull up for you. This is just on the spot chart here. And you can see here that the blue bars represent the Asian sessions, more or less, and the pink bars, vertical lines here, represent the US sessions. And what you guys can notice is quite interesting. If we look in the pink sessions, which is Asia, you can see that in general, what's happened here is sorry, the pink sessions represent the US. Sorry, did I get that wrong? The pink sessions are the US and the blue sessions are Asia. So let's look at Asia. So the blue sessions, you can see in general, there's been selling of the US dollar versus the yen. So you see here's selling here, look here, selling, look here, selling. Now, when we go into these pink kind of lines, that represents more or less the beginning of the North American session, and there's been buying. You can see that it's been mainly buying or sideways price action. So what that's telling me is that in order to see really sort of continuing strength in the Japanese yen, we actually have to see North American traders sort of selling the dollar a little bit. And they're not really doing that much at the moment. So this is quite a sort of geographic thing. So just keep an eye on that. It's a similar situation which we saw in the gold market, that the Asian session was causing a lot of buying in gold, whereas the North American session was not. So just keep an eye on these sort of the different sessions here. So that's something to be looking at. Just why we've got these charts open, I also want to give you an update on the trends here. So let's have a look at the trends for FX. As you can see, the overall trend, I would say, actually is for stability. And you can see here that the average true ranges on a scale of 0 to 1,000, most of them are sort of in the lower lower parts of that. Nothing too crazy here. The only thing that's got the in Norway that's pushing quite a lot higher. But above that, the only trends which we can see, which are slowly starting to pick up from fairly tepid levels, we can see gold here at a 2.5. So that's starting to push a little bit higher. But again, not a very strong sort of trend. In terms of other trends, we can see, CAD relatively soft. We can see AUD a little soft. NZ a little bit soft. We can see a little bit of strength in the JPB. Japanese yen, as you can see. What is interesting, though, is that is this yen trend turning around? So you can see here, going back about 2 weeks ago, that we were actually in a negative trend. And as you guys can see, that's been neutralized and we're back at a 0 point. So it's going to be interesting here to see if that can pick up some steam. The other things which I'd say is quite interesting is that the euro, again, is not really doing much. Look at that. It was in a sort of upwards trend and it's just sort of now coming down to flat. And what we can see is it possible we're going to see a slight pickup in US dollar weakness. So overall, the markets are just in sideways consolidation. And I could say, what I would say is that, maybe a slight weakness in the US dollar as a trend and a slight sort of strength in gold, but nothing particularly radical at the moment. Okay, so just getting back to a couple of charts here, let's just have a quick look. So that's the yen we just looked at. Let's have a look at the euro. As I can say, just where are we here? Let's pick up the euro. So again, looking at the chart, it did bounce off its sort of fib retracement here, the 61.8%, which is also the 50-day moving average. It's pushed up above this sort of bull flag here. But again, just sideways consolidation, probably looking again for sort of more clarity about the ECB, US economic data, the tariffs, and the spending bill. Not a huge amount to say there. What I would like to talk about also is just oil. Now, oil, which is here on this chart here, you can see that's been in a sort of a gentle downtrend. Just in terms of the technicals, we can see that all the moving averages here more or less pointing in a downward trend. So the downward trend remains intact, and oil hasn't been helped at all. You can see here it was rejected at that sort of a recent sort of swing high at about 63.80, and you can see here it's being rejected. And now this is starting to get into quite key levels. If we put this on a 4-hour chart, which is easier to see, you can see that rejection there, and you can see here that from this most recent impulse starting on the 4th of May, you can see we're now at pretty key levels. The first test here for the bulls, are they going to pick it up at about the $60.50 level, which is a recent low, swing low, and also the Fibonacci retracement here. So far, just holding in a sideways consolidation. You see the moving averages on the 4-hour chart are actually flatter than on the daily chart. But oil's case has not been helped by uncertainty over the global sort of economy. And secondly, the fact that there's been some rumors in the last 24, 48 hours that OPEC Plus might actually further increase their output, their production output by another 411,000 barrels. So remember, that was the figure they increased at the last meeting. And the idea is that at their upcoming meeting, they may be tempted or they may want to increase that. So as long as OPEC Plus continues to increase their output and there's uncertainty about tariffs and the global economy, we have to say it's going to be difficult for oil to do anything other than trade in a range. And it looks as though the range here is, something around about late 50s, 57, $58, maybe up to mid 60s. It's sort of in that $8 to $10 trading range. But what I am looking at today, although again, the markets might be relatively sort of sleepy, is just to see the what happens just in this fib zone here and whether this pretty key level here at 60-50 is actually supported. Definitely something to be keeping the eyes on. Other thing to be looking at is gold, which is here. Let's just bring it up. Again, gold with the softer US dollar, still a sort of uncertainty about what's happening in the US and a potential debasement of the US dollar and fiscal lack of discipline. You can see here gold pushing high, and it looks as though it wants to break out and maybe retest the most recent highs at about 34.50. What is interesting here is that just on this recent sort of sell-off, which you can see here started on the 7th of May, and going from that impulse here, we've now actually broken above all of the fib zones. So we've broken above, the 50% and the 61.8 retracement. So you can see now that gold, that's definitely a bullish pattern. If you look at all the moving averages, going from the 20 all the way through here to the 200-day EMAs, gold is above all of those. So, from a technical perspective, this is in an uptrend. Momentum is still long, and the fundamentals still support further upward progress in gold. We have a weak and weakening US dollar. We have a sticky inflation. And we saw yesterday, for example, in the PMIs that the input prices were actually pretty high. So we still have sticky inflation, at least in the US, and potentially even in places like Japan. And thirdly, we have the just a lack of fiscal discipline in the US, which is a good environment for gold. And a similar thing here for Bitcoin also is lacking, or basically all of those factors. You see here that Bitcoin, again, all the moving averages high. It's broken out of the trade range. As I pointed out, I think yesterday, if you look at a Fibonacci extension going all the way back to this initial sort of up impulse from the middle of August. Last year, you can see that, at least if you measure out this Fibonacci extension, BTC could definitely go up to test to 120, 130,000 kind of mark. In the meantime, though, it looks as though it could just be back testing a little bit just to test the support back here down at the top of the range at about 108,000. But Bitcoin is looking strong. So finally, just want to talk about the treasuries. We saw yesterday, basically on the back at about 7 o'clock in the morning. Excuse me, I'm just going to grab some tea. About 7 o'clock yesterday morning, the House of Representatives in the US did actually pass that spending and reconciliation bill, which of course is considered to add to the deficit. And so the 30-year bond market did not like that at all. And we can see the immediate reaction. Well, this is a daily chart, but basically the immediate reaction here was for the yields on the 30-year to spike higher, also on the 10-year, also the curve bear steepened. But what you can see here is that at that sort of resistance, which I sort of was pointing to at about 5.17, the market didn't quite get up there, got to about 5.15 and decided to take a bit of a pause. Now, does that mean that the action at the long end of the curve at the end of the curve is over? No, I just simply think that that was probably a good moment for profit taking and a little bit of the first kind of overhead resistance at 5.15, 5.17%. And now we're back this morning. The yields have they've backed off about 15 basis points or so and just retesting the 5% level, which is going to be very interesting to see if that holds going over the weekend. Possibly there won't be too much action because the bond market is closing early this afternoon, and then again on Monday the cash bond market. So let's see what happens there. But also we saw that the yield curve. So you look at the 10s, 30s. Also continuing to steepen. So even though their outright yield has come off a little bit in the last 24 hours, the 10s, 30s curve still remains very, very steep. And if you look at the 5s, 30s, also very steep. And if you look at the 2s, 30s, Also, well, not quite as much, but definitely sort of, the belly outwards is actually in a steepening kind of mode here. So the point being here that the bond market is unhappy. Probably what we're going to have to see is what happens in the Senate, and this is going to be a binary, well, a relatively binary outcome. If the Senate is fiscally responsible, if the senators decide to actually cut further spending and do not allow for egregious sort of a lack of fiscal discipline, that could actually be viewed quite positively at the long end of the curve. Because remember, the long end of the curve doesn't like the idea that the budget is blowing out, that the deficit is blowing out, and that there needs to be more long-term issuance there needs to be more issuance of long-term bonds. So the point is that if the senators are fiscally sort of courageous and basically say to Trump, no, 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 you can't have all your goodies, the long end of the bonds might actually like that. We could actually see a little bit of long end led bull flattening. So the long end yields coming down a little bit, and that could cause actually quite a lot a sell off in terms of the flattening, and actually could cause some buying of the 10s and the 30s. We'll keep an eye on that. But again, this is probably going to be a story going into the next 2, 3, 4 weeks, because there's going to be a lot of horse trading. There's going to be a lot of to and froing. Trump says that he wants the final bill on his table by July the 4th. So that's still 5 or 6 weeks away. So, probably at the moment we could get some range trading here at the long end of the curve. And as I say, what was interesting is that in terms of the equity market, and this is the final thing I'll just talk about here, in terms of the equity market, keep in mind that historically, I was looking at some numbers yesterday. How can I put this? Historically, it's not necessarily the level of the yields which are important. It's the rate at which yields change. And I was looking at some work from Goldman Sachs, which was essentially showing that the largest equity sell-offs in terms of changes in the long end yields, it's not so much the level, it's the rate of change. If there's more than one or two standard deviations of change in the yield. So it's the speed. That's when the equity market quickly pukes and goes down. So the point is that if the equity market is given 6, 12, 18 months for a slow grinding up of yields due to strong economic growth, equity market can often actually deal with that because it's a sign of a strong economy. But what the equity market does not like is volatility. It does not like speedy changes in the yields which are very quick. And as I said, Goldman Sachs put out some charts yesterday where they were showing the standard deviations move. And if it's too fast, that's when the equity market tends to revolt. And what we've seen over the last few weeks in the bond yields at the long end has been a speedy move upwards, and that could also explain not even so much the levels at 5%, which is high, and the real yields, as I say, are about 2.75%. So with a 2.75% real yield in the 30-year, that is not great for the real economy. Because you imagine if you're, I don't know, a condo developer or trying to open a factory or invest in a new project, real yields of 2.753% are not fun, and they will definitely slow down the economy. But the point also, just from a mechanical point of view, is that these very fast changes in the yields, the nominal yields, is historically been poisonous for the equity market. So we see here, looking at the equities, it looks as though the sell-off continues to happen. I'm just going to put this on a 3-minute chart now, just as we finish, just to see if this Trump tweet. Yeah, so it's interesting here. You can see not only for Apple, I'm just going to put it back to regular trading hours here. Yeah, so you can see here on the um, e-minis, we can see that thanks to that Trump tweet, not only Apple but also the S&P 500 come down about 40 points or so. So it's going to be an interesting day. Let's see if the market wants to go with this sort of continuing weakness here, or whether it just wants to stabilize on the low volumes and low liquidity as we get towards the end of the day. Okay, guys, I think that's about all I wanted to say. Let's keep in touch, keep the conversation going, and have a great day. Thank you.